To fully understand where the economy is headed, we must look below the surface, discovering the trends that shape our investments and all financial markets. We're going to review the market correction we all just experienced and see where it leaves us now. Moving forward, our goal as a channel is to dig below the surface and see the economic data for what it is, so we can be at the front of the line catching the next major market trend. This is the S&P 500. Now we're looking at over here is the big sell-off we all just experienced over the past couple weeks, hitting highs of 6147, ultimately touching lows around 5504. That represents a 10% drop in a relatively short amount of time, which is pretty significant. We consider the Dow Jones Industrial Average. Roughly during the same period of time, we dropped from a little over 45,000 to lows around 40,600. That also represents a 10% drop. Considering the Russell 2000, we hit highs of 2326. Now, not all-time highs, but recent swing highs over the same period of time, hitting lows in 1984. That represents a 15% drop. But of course, we know this sell-off was led by the Mag 7, those really big technology stocks that have been at the forefront of the bull market over the past year. Well, the Mag 7 ETF hit a high of 58.69, eventually hitting lows of 45.80. That represents a drop of 22%, a huge drop considering the market cap of these stocks. Now, in terms of the market indices, we have the S&P 500. That's comprised of the large cap companies, the 500 largest companies that represent the U.S. economy. Again, that dropped by 10%. The Dow Jones Industrial Average, that's a more narrow market. That's 30 of the industrial companies, also dropping by 10%. The Russell 2000 is a small cap index, and that usually is more volatile than the S&P or the Dow. That dropped 15%. But surprisingly, it didn't drop a lot more than the larger markets, which we would expect. However, the Mag 7, made up of Amazon, Meta, Google, Tesla, Nvidia, Apple, and Microsoft, that dropped an average of 22% from the recent swing highs. And that really does tell us something. The market leaders, well, the leadership has been hurt. You see, and this is a concept we've spoken about recently, that we analyze the bull market and what brought us up to these highs. Those are the big stocks, especially companies like Nvidia and Tesla. They've been hurt. So in order for the markets, these indices, to make new all-time highs, well, there has to be new leadership, or our past leaders like the Amazons and Teslas, they have to regain their upward trend. But that's not so easy. So with that said, where does this leave us? It leaves the market in a very vulnerable state, because without the leadership, negative news, possible black swan events, they have the potential to really bring us down further, over the long term. Now, investing with macroeconomics, it really is the goal of this channel to dig below the surface, to uncover these trends and try to, connect the dots. Tracking the macros allows us to identify the trends and possible changes within the economy. Now, we should understand the difference between investing in a cheap stock in a strong sector or investing in a cheap stock in a declining industry. That's the difference between buying a stock that, let's say, was $100 and dropped down to 20. Well, is that a great value, for example, right now after a huge market sell-off? Or is that $20 stock eventually going to zero because the industry is just being replaced by something else? And this question is now more pertinent than ever with all the new innovations, including AI. Now, let's take a look at some of the big numbers, and we're going to show you how the trends have developed and changed and how we can really use this information to our advantage. So we had this morning Empire State Manufacturing Index. That was released at a level of negative 20. That was a drop of over 25 points, by the way. That was a huge move. Now, taking a look at the chart, we can see this is the lowest low we've seen since January of 2024. So this is over a 1-year lows. And also, again, one of the biggest drops we've seen in a very long time. Now, Consider on the right hand side, Empire State Manufacturing, where we are right now, again, negative 20. Let's compare it to where we were in 2008, the equivalent level. And that puts us at levels we have not seen since October of 2008. Now, we mentioned the 2008 recession, not to imply that we're going to follow that cycle exactly. Every market, every trend is different. But we all know the 2008 financial crisis, so it helps put some of this in perspective. Now, the Empire State Manufacturing, and analysts cite because of the threat of tariffs or other factors, regardless, negative 20 puts us at levels that are really just before the recession of 2008, really kicked in, and that is concerning. So we're going to try to keep track of these. So far, our scorecard gives manufacturing, well, we'd grade this as pre-recession, right before the recession started in '08. Now, of course, that's one number. We have to look at all the numbers. Let's take a look at retail sales. This was also reported earlier today. Now, retail sales is broken down in several categories. What is interesting, notice how we dropped from April of 24 through February now of 25, just about 10 months. We dropped from levels that were in the healthy positive direction to negative 5.3%, and that's on a year-over-year basis. Electronics and appliance stores in particular. Make a note of this when we think of the earnings season and which stores might benefit or not benefit from this. Also very complementary to this are non-store retailers. This is online shopping, Amazon, things of that nature. Well, we've dropped from 6-7% year over year, much lower, and we're now coming off of last month's lows of 3.7%. This month is a good uptick, but still not in a healthy position. But there is some good news. Take a look at grocery store sales on a year-over-year basis. That's up 4.3%. That's the best number we've seen in a while. Also, food and beverage stores, also related, up 3.9%. That's also one of the best numbers we've seen in a while. Maybe this is inflation related, though. We know from our recent inflation data, food is really leading whatever inflationary force is higher, not online shopping. Let's compare it to the overall number, the overall index of retail sales. Where were we in 2008? Well, the current figure at 3.4% on the right-hand side, that matches up pretty closely with the January levels of 3.1%, January of 2008. So going back to our scorecard, retail sales, they're not great, but they're good. Now I know the online shopping and the electronic stores, those don't look so good, but that is balanced by other stronger areas of retail sales. So overall, it looks pretty good. How about employment? This is a big subject. Well, we have the non-farm payroll number. The last figure we know is 151,000 new jobs created. Unemployment rate, 4.1%. Remember, though, the government layoffs are not factored into this. So next month's non-farm payroll, we should exercise quite a bit of caution. Now, the non-farm payroll, again, matches up 151,000, better than the prior month of 125, but that's not really where we want to be. Strong economies are associated with non-farm payrolls in the 300s. We're at half that level right now. Well, where does 151,000 jobs match up in terms of the 2008 recession? Around May of '07. Now, notice May of '07, we had 148,000 jobs created, and it wavered. But all of a sudden, in August, it turned negative, and then all of a sudden, the economy really, kind of took a turn to the downside. Also, notice that the jobs market really kind of turned in '07 before a lot of the other indicators, almost as if it's a leading indicator. In terms of our scorecard, the employment, poor conditions. Probably not as bad as manufacturing, but not that much worse either. And this really is a cause for concern. How about housing? This is also really important. On the top, we have the 2025 levels. We have several different categories. So we're going to show you, all at once what they tell us. On the bottom is a 2008 recession starting in January of '07 through December of '08. And let's take a look at building permits. This is a leading indicator. And this shows us the amount of permits that are issued for future construction projects. Well, this is encouraging. The current level, and this is in thousands, so we're looking at 1.4 million. That shows really kind of matches up to where we were of May of '07. Now, remember the housing market, May of '07 did not look so good, but as far as building permits, that still is a pretty positive sign. Housing starts also looks pretty good. Current figures, 1366, which comes pretty close to the 1354 level in July of '07. So in terms of building permits and housing starts are leading indicators, that puts us back to mid '07. That was a strong economy. Now we look at new one family homes for sale. Current figures 495. But that puts us at levels now we're approaching early 2008. And considering how crucial, how it's at the center the housing market was in terms of the 2008 recession, it's important to note the difference. We drop below 500, and that really is important. Construction spending currently at a 3.3% level on a year over year basis. That matches up with October of '07 levels. That's pretty good. But notice how quickly that positive figure turned negative in the beginning of 2008. The monthly supply that shows us the inventory, the number of months we would need to sell all the new homes. Well, we're currently at a pace of 9 months of inventory. The higher the number, the more inventory we have, meaning the harder it is for the market to sell existing inventory. A higher number is bad news. Well, that matches up where we were around, fourth quarter 2007. That's pretty good. But then again, new homes sold, we're currently at 657. That puts us at levels right around first quarter 2008. So the real takeaway from this, that while building permits and housing starts, construction spending not bad, the new one family homes for sale and the new homes sold, and also the inventory figures, they're starting to show signs of tapering. So, in terms of our scorecard, the housing market, there's a moderate trend, but there is cause for concern. And again, what we really hope to accomplish with this approach, with this and other economic numbers, to spot the trends, to understand what these current levels mean, and for us to be on the lookout for changes to the positive or negative. So just for example, the housing market, the building permits and housing starts, they look good. If they start to turn south, that would complement the already poor new home sale numbers. But conversely, if the inventory improves, if the new homes for sale improve, that could be a sign of overall industry improvement. Speaking of housing starts and building permits, that's on Tuesday. We have very big numbers this week, and that certainly is no exception. Industrial production, capacity utilization, those are manufacturing numbers. We also have big manufacturing numbers this week. That's important to watch. Wednesday, that's a big day. Federal Open Market Committee meeting. And then on Thursday, Philly Fed, existing home sales. So we have housing, manufacturing, and a Fed decision this week. All very big numbers, and we're going to do our best to track these and put them in perspective with all the other things going on so we can hopefully assess the current state of the economy and be at the front of the line for the next great, financial trend. We hope this has been helpful. We look forward to seeing you back soon.